Jim Grabovac, why do I want to be in a municipal bond fund right now?
Greg, they really represent strong value in today's marketplace. Investors know that nominal yields are very low, but if you look at municipals relative to treasuries, for instance, they're quite cheap. And one of the reasons that the market is offering good value has been very strong volume this year. We're up about 60% versus last year's pace. So a lot of issuance, bonds get cheaper relative to other alternatives. We think munis represent good value in here.
But do you get enough yield for the risks you're taking?
Well, we think so. Credit quality, despite the headlines that you read in the press, is improving broadly in the municipal market. We've had nearly 7 years of economic recovery, and that's really bolstered tax revenues. It's helped the housing market increase, and that's helped down at the local level. So good credit quality and good relative value.
And in the McDonell Intermediate Municipal Bond Fund, you own a lot of education bonds, especially compared to your benchmark. Why do you like these so much?
Well, it's one of the higher yielding sectors in the market, and we think you can get extra spread, extra income, and still very good credit quality. Broadly speaking, there are some challenges in higher education, as you know, with demographic challenges facing institutions. But if you look for very strong institutions that have a niche, a lot of demand, we think you can uncover some very good value with fundamental credit research.
Now, everyone in the bond world is waiting for that first Fed tightening. What's it going to do to muni bonds when the Fed finally raises rates?
Well, it's an interesting question. If you look at the last 25 years, we've had 4 instances where the Fed has tightened, ranging from 25 basis points to as much as 425 basis points. And people are afraid of the Fed raising rates and what it might do to bond prices. But the average return for the municipal market as a whole over a 2-year window past the first tightening is more than 5%. So historically speaking, the market's done very well relative to Fed action.
And then finally, underpinning a lot of the rally in muni bonds is bank buying. Why don't you talk about why banks are so aggressively buying bonds nowadays?
The banks coming into the 07 recession held roughly 7% of the outstanding market. Today, that's total runs up to about 13%, and they've been consistent buyers throughout the past several years. We think that's important because it indicates institutional interest and banks finding very good value across the longer end of the municipal market.
All right, thanks a lot, Jim.
Thanks, Greg.
And thank you for watching The Street.